Hello, everyone. Thank you so much for being here with us today. This is a presentation that we've been looking forward to. An article of the same title just came out in Eurobike this morning. So if you get the chance afterward, it's a great read and I would really suggest going over there. So today we have Jay Townley presenting The Golden Age of Globalization is Over. And I will not delay any further. Thank you for being with us, Jay.
You're more than welcome, Rochelle. Glad to be here. For those of you that get our newsletter, you've already seen the article, The Golden Age of Globalization is Over. I want to make it clear that I, at this point, am not saying that globalization is over. I'm simply saying that the golden age that we've enjoyed in the bicycle business is over. And so there's going to be changes that we're going to have to get used to and make sure that we're prepared for and also accommodate. Now, I'm going to start this presentation with a quote. The golden age of globalization that we experienced in the last 30 years since the end of the Cold War has ended clearly, and we are entering a new era that will be marked by greater geopolitical contestation, close quote. Now, this is a quote from Singapore's Deputy Minister of Finance, Lawrence Wong, at the Forbes Global CEO Conference, September 26th of this year. It was paid attention to by the global community, but I also point out that Singapore has been an important manufacturing location in Asia for Shimano for a good number of years. Shimano established Shimano Singapore in 1973, and they opened a sales office for all of Asia in 1996. So Singapore is the hub of what Shimano, as a major component supplier, is doing in the Far East. It also in supplying the Chinese, Vietnamese, Cambodian, the Southeast Asian manufacturers of bicycles and e-bikes. Now, in simple terms, globalization, which isn't really completely understood, but globalization is the process by which people and goods move easily across borders. Principally, it's an economic concept. It's the integration of markets, trade, and investments with few barriers to slow the flow of products and services between nations. In the case of the American bicycle business, it actually goes back almost 50 years. Before the pandemic, it represented low cost but skilled and efficient local labor, engineering, and management to manufacture bicycles and e-bikes. Now, it also had available relatively affordable raw material and regionally available componentry, because the component manufacturers built clusters of component manufacturing facilities to support the manufacturing in Southeast Asia. And you can combine that with, at the same time, the development of very efficient and affordable ocean and domestic shipping. Now, I am trying to make sure we get over to the next slide. I mentioned to Rochelle that we go through this every time I do a webinar. There we go. It's a timing issue. So here's the agenda for today's webinar. Now we're going to start by answering the question, what is or was the golden age of globalization that the American bicycle industry enjoyed for all those years? Well, we're going to take a look at the changes the pandemic accelerated from March of 2020. And we're going to visit the McDonald's theory, if you haven't heard of it, and some of the things that can be fixed and some that are changed forever. We will explain why and when inventory becomes evil, and why it's all about consumer demand, leading to a shakeout, if you've never experienced one. And we're going to take a look at how e-bikes have changed the game, and at the new era of supply networks, and why the American bicycle business will have difficulty disengaging from its supply sources in China. And then we're going to close with a summary and a question and answer session. And as we've done in the past, Rochelle will make sure that any questions that we don't get to in the Q&A session, she will send them to me so that I can answer them by email after we close the webinar. Now, what was the golden age of globalization? Many of you, perhaps all of you, have known nothing else before the pandemic was declared in March of 2020. What was it? West Coast Cycle, this goes back a long way, folks, to the 1970s. West Coast Cycle had started to tap into the low-cost labor of Asia, and primarily in Japan at first. And the new innovations in containerization ocean shipping prior to the Great American Bike Boom of 1971 and 1974. Many of you may not know that there were no containers or container ships prior to that time frame. And they were invented, by the way, by an American and US lines. Now, just prior to this, bicycling became popular after President Dwight Eisenhower had a heart attack. And his cardiologist, Dr. Paul Dudley White, shown right here in this brochure, I'll touch it with my cursor here, recommended riding a bike for exercise. And these are some pictures from that era. And these guys, by the way, you probably don't recognize. This is Dr. White right here in the middle. This is Secretary of Commerce Udall from Utah. And this fellow off on the left is, at the time, the majority leader in the Senate. This is Hubert Humphrey, who later ran for president. I'm sure you don't care about going down memory lane, but Dr. White got them all out with a bunch of other congressional leaders to ride bicycles as he was recommending to Dwight Eisenhower, get on a bike and ride and exercise. Now, after the bike boom and during the shakeout from 1975 to 1980, and yes, there was one, the company I worked for, Schwinn Bicycle Company, found itself in a financial situation, including an inventory glut, that resulted in totally shutting down domestic production and outsourcing 90% of its product to Giant in Taiwan, taking full advantage of globalization. 10 years later, Schwinn followed the Taiwanese bicycle industry and globalization by sourcing in China. Several bankruptcies, by the way, followed Schwinn over the next 30 years, as you probably well know, until the brand was acquired as a part of the Pon Holdings acquisition of Durrell Sports from Durrell Industries in October of 2021. Now, I've described the last 20 years as a pleasant place that changed with the seasons, but with very little, if any, real disruption beyond that. Rick Vosper accurately describes the state of perfect competition that prevailed from the year 2000 to the first quarter of 2020. When the pandemic started in March 2020, the American bicycle business was totally import dependent. You'll hear that term repeated several times. And 95% of all bicycles sold in this country were imported, primarily from China. So in other words, the American bicycle business was, as we've stated before, totally import dependent. This includes e-bikes, by the way. The bicycle business in the US became comfortable with Chinese holidays and planning its activities, including model year changes around the Lunar New Year. When I was at Schwinn, I can remember we did calendars for our purchasing group that included all of the Chinese holidays, because we had to make sure that we were in sync as to when our vendors would be available in China and when they would not, and Taiwan as well. Now, lead time for finished goods, as shown here, was a consistent 45 days from date of firm order, that is when you firmed up the forecast and you made it an order with money behind it. So 45 days from the date of a firm order to sealing the container at the factory. Ocean freight rates and in-transit times fluctuated within a narrow band of predictability, with the occasional labor dispute, storm in the Pacific, or economic hiccup. But the point is, for 30 years, the American bicycle industry was comfortable and I would say somewhat complacent with the rock solid globalized 40 to 45 day lead time for complete bicycles. Now, as all of you know, the pandemic accelerated many changes in American business and society, including growth of online shipping or shopping, I should say, growth of online shopping. I think all of us, including me, I'm an old guy, went online to shop. Now, this chart shows total e-commerce retail sales as a percentage of total US retail sales, including brick and mortar, and the accelerated change starting in 2020. So if we take the cursor and we go to 2015, 2020, and go up, you can see that online was on a track moving upward until the pandemic hit, when it spiked. And then it started to taper off as we got into the pandemic, but still today is at a high level, coming down from about the 18, 16, 17, 18% of all retail sales to below that, somewhere in the range of 13.5 to 14% of all retail sales. Now, the growth of online goes hand in hand with the working from home and home delivery. And people stayed home and sheltered in place during the pandemic, and telemedicine became popular and still is. It continues today. And we also had a surge in small business startups, which still amazes me. And this, while it's been associated with the great resignation and people being dissatisfied with their jobs and quitting to get another job, many of them also quit to strike out on their own, taking advantage of a whole different way of doing business and commerce on the internet. So these are just a few of those changes. I want to go back with this chart that is from this past Friday, Black Friday. And it shows the record, and up in this corner, this is $9.12 billion from online shoppers this year, 5 days ago. This is despite concerns about inflation and the resulting higher prices. Traditional brick and mortar store purchases are still expected to account for the majority of retail spending. Again, bike shops and the bicycle business in the United States is still primarily anchored on brick and mortar, although we've had this growing e-bike driven direct to consumer component. Now, the National Retail Federation expected 67% of Black Friday shoppers to shop at stores. National Retail Federation, or NRF for short, expects more than 166 million Americans to shop either in person or online over the 5 days just ended, from November 25, Thanksgiving Day, through yesterday, Cyber Monday. This is the NRF's highest prediction since it began tracking data in 2017. What's going on here? Well, at the same time, you've got inflation, you've got receding sales in many categories, including the bicycle business. You've got consumers that are buying at higher rates than they have in years. Now, part of this is because Americans are turning to buy now, pay later orders, which allows shoppers to pay through interest-free installments. I know many bike shops are latching on to buy now and pay later services, but buy now, pay later orders spiked 78% this past week compared to the previous week. And revenues from these type of orders, buy now, pay later, were up 81% over the past week. Now, this is the bigger picture of the bicycle order lead time graphic that I showed you earlier, the 40 to 45 day lead time. This expanded graphic shows the bicycle supply order and forecast flow. And I'll go through the detail of it quickly, but down below is forecast coming from the American side. Then in turn, they're followed up with orders that are firming up those forecasts and then moving on to scheduling for component suppliers. Now, what occurred during the pandemic is this order and forecast flow, or this graphic, was maintained. This hasn't changed. Whether the source plant was in China or Vietnam didn't matter. In turn, there's been very little to change any of this relative to the American bicycle industry since 2019 all the way to the present. Now, you might recall that when the pandemic hit in March of 2020, shortly thereafter, two of the leading global manufacturers in our business, the OEM giant and the leading component brand Shimano, both made, by the way, are both public companies, publicly traded on stock exchange. They both announced early during the pandemic that they were not going to expand their manufacturing facilities. They would add shifts, they would do what they could to improve throughput, but they were not going to build new plants. They were going to go with the facilities they had. Now, we don't disagree with their decision. And by the way, we can explain why that is still a good decision. But the significance was lost on many other manufacturers and brand companies in the micromobility space who evidently believed that the surge from 2020 through this year, that surge in sales, they believed, would continue beyond the pandemic, wouldn't end. What Giant and Shimano foretold was the difficulty in future nearshoring and reshoring and changing the American supply chain and decoupling, not just disrupting, but decoupling from the Asian and Chinese sourcing. Now, what happened after March 2020 to the lead time for complete bicycle product was, as this graphic shows, disruption into the unknown. Remember when the pandemic started in March 2020? I remember exactly where I was and what I was watching. The American bicycle business was totally import dependent, and 95% of all bicycles sold in the country were imported primarily from China. In other words, the American bicycle business was totally dependent on globalization and the global supply chain. Now, you may have heard of the McDonald's theory. It goes like this. Where we have McDonald's everywhere, the more we trade and invest in each other, the more we tamp down geopolitical rivalry, the less likely there will be in contestation and war. This also served as a way of explaining globalization. Where there's more McDonald's, you're going to have more trade. After March 2020, the McDonald's theory became history. And the pandemic itself, induced by COVID-19, was followed by the invasion of the Ukraine. So what you see here at the top is McDonald's in China, could be Taiwan as well, or Southeast Asia. In the middle, McDonald's in Russia. By the way, they're no longer there. And below is McDonald's in Saudi Arabia. So the fundamental change in the way the world and sourcing works is now underway, as we stated. Countries have not fully retreated into protectionism. And I want to be clear here that there's nothing that I'm doing that's predicting the end of globalization. What I am talking about is the change in globalization, and it's a fundamental basic change. But business and being increasingly influenced by geopolitical tensions, leading to friendshoring, nearshoring, and reshoring, all intending to shorten supply chains and bring manufacturing closer to customers. So if there are more disruptions like we are going through now and have experienced for the last 3 years to occur, you can get product to consumers without the lengthy delays and disruptions that we previously experienced. With that said, it's ironic to me that Taiwan is still the center of the American bicycle business in Asia that leads China and other Asian countries, while the geopolitical tension between Taiwan and China have triggered nearshoring, including interest in the Chinese manufacturing enclaves in Mexico. Now, some things that COVID broke can be fixed, but others are changed forever. The supply chain is still screwed up, in simple terms, primarily by China's zero tolerance policy that has worn out its people with sporadic lockdowns that have continued to crop up, affecting millions of people, workers and factories over the last 31 months with no end in sight. And what we've seen most recently as part of the end result of that, which are the disturbances and the protests that we're seeing in mainland China. And while they're quieting down now, they're still out there. This also means disruption to manufacturing. If people are out protesting, they're not working. Bicycle manufacturing facilities, component supply, and raw materials are all affected, as are the ports of entry and related U.S. logistics. The supply chain is one of the things that eventually will be fixed, or at least will get better over time. Now, the New York Fed has a measure of global supply chain pressure, which you actually see here in this chart, which is an index weighing delivery times, backlogs, and inventories. And as you note, it's back down to levels last seen at the end of 2020. So the pressure relative to global pressure on the supply chain is definitely easing. Part of the reason for that is shipping costs from China to the US have plummeted. I love that word, plummeted. Despite the erratic behavior of Chinese base sourcing in the short term, shipping costs for containers from China to the US have plummeted recently. Now, I am no fan of the steamship lines, as they're called, the container shipping businesses. They've made a bloody fortune. And as we'll see in one of these charts, you could track how that has gone up and down. But in order to deal with the dramatic reduction, the plummeting of sailings, of demand for containers at this point, demand for shipping of goods, the ocean shipping companies have responded by canceling dozens of sailings, adding to the uncertainty, by the way, because they do this in some cases capriciously. Now, while they cancel a sailing, this is at a lower cost, obviously. So it should also be noted that lower shipping costs will not reduce the landed cost of the goods already in U.S. inventory. What they're going to do is help the shipping lines try to maintain some kind of stability in their pricing so it doesn't go down even further by simply reducing the number of ships and the number of times that you can ship a container from Asia to the United States. I love this chart. In January 2022, this shows you the reality. To quickly recap, here's December 2020, and here's October 2022. In January 2022, it cost approximately $10,000 to ship a 40-foot container containing bicycles or e-bikes or componentry or parts and accessories from Asia to the US West Coast. $10,000. Okay. 10 months later, October 2022, this year, it cost $2,000 to ship the same 40-foot ocean container from Asia to the US West Coast with the same goods in it. That's how dramatically the rates have come down. It also means that's how dramatically the demand for freight and the product coming out of the plants to the ports has come down. Now, some of you will remember webinars earlier this year when we reported 100 or more container ships waiting from Asia to get into U.S. West Coast ports. As of 7 days ago, on Tuesday, November 22nd, the number of container ships waiting off the U.S. West Coast ports was 0, not a 1. Now, with this said, labor disputes are still simmering, as you're well aware from the news. Rail workers' unions have rejected the tentative agreement worked out by the Secretary of Labor in the White House. So there's now a renewed degree of concern about a settlement dialing up the uncertainty relative to will we get goods. And the latest being what you've seen this morning and yesterday is the President of the United States, President Biden, has asked the Congress to step in before December 9th with legislation that makes sure that there is no strike and that the rail workers go back to work until there is a settlement. Now, there is still no labor contract between the U.S. West Coast ports and the dock workers, and the Secretary of Labor reports a settlement is moving forward, and there are also no current threats of work slowdowns or stoppages. However, here's another pain point for the uncertainty index. Here's the last piece of the shipping puzzle. Domestic and shipping demand is also receding. This is trucking, and trucking rates are falling as the end result. This is an October clipping, October 31st, but U.S. domestic shipping rates continue to go down. Now, lead time will be an early indicator of the supply chain getting better, or so we say. I still marvel at the ability of the bicycle business to seemingly ignore the inventory that has been amassed in what I believe is every nook and cranny of the global bicycle supply chain, every nook and cranny that supply chain possesses. And in turn, that supply chain has caused to be constructed and has leased and rented every bit of space it can over the last 4 quarters. Now, this chart is from Bike Europe, but it still reflects the fact that lead time increases since the pandemic have not eased. Now, what do you got here is a chart that says in tan, February 2020, in gray, maximum in 2022. Let's take frames and forks. Now, again, this is Europe, but it was the only indicator I could find in the industry that gave this amount of detail. So this is months. And frames and forks were 3 months, under 4 months lead time back in 2020. Today, they're over 16 months, headed to 18 months. Let's pick out brakes. This looks like about 2 months. February 2020, 12 months, a year, 2022, and so on. Transmissions, under 4 months, 3 months, or a little more in 2020. Today, a year. Now, I am convinced that part of the problem is the amount of inventory that has been hoarded, in my view, by the OEMs in Asia. And that in turn is why we're seeing these kinds of lead times as we take a look at the current situation. But if you back up and take a look at freight rates, at ocean rates, at all the indicators, there is a definite slowing, not being reflected in the lead times for componentry, for all of the bits, pieces, and components you need to manufacture bicycles and e-bikes. And I expect to see this come down, but I also expect to see some other problems associated with pricing in the interim. Now, I've told this story before. And while at Schwinn, I reported to Bill Austin, who is no longer with us, sadly. And Bill at the time, and this goes to the late 70s, early 80s, was a group vice president. He was new to the company, he's new to the bike business. He came in at the end of the bike boom when the Schwinn Bicycle Company had a huge manufacturing inventory as well as a finished goods inventory. The market sheared almost 50% in 1975 in 1 year. Just so to say the bike boom ended, it ended with a crash. Bill explained his view as he came in the company. GE trained and educated from the standpoint of where he had learned his skills and where he was shaped and formed as a manager, but also a believer in Peter Drucker, the writings of Peter Drucker. And he explained his view to his senior managers that inventory is evil. As we in turn worked at selling off this inventory overhang that was the result of the bullwhip effect, which I won't harp on anymore in this webinar, but have in past webinars. And in turn, we were holding what was the result of the bullwhip effect, mostly based on purchasing for manufacturing inventory, because we had a plant or plants that made 1 million bicycles in Chicago the last year of the bike boom. We also imported 250,000 bikes under the Schwinn approved label from Japan. Now, as I said, that was about 4 decades ago. And today, some, perhaps many brands and retailers have shifted from 30 years of just-in-time or JIT inventory management, which Bill Austin believed in wholeheartedly, to just-in-case or JIC inventory management. This, in turn, has resulted in a story we reported on a year ago from the New York Times, that the supply chain problems have small retailers gambling on hoarding. Bicycle finished goods inventory in the US is high, but not balanced, in that certain models and categories are still either out of stock or in short supply. Top-tier brands are informing their dealers that back orders still cannot be canceled, as they're taking in the shipments they could not themselves cancel or change. And so retailers are in that same fix, they're saying, and they begin to roll out, in some cases, 2023 model offerings. Now, with this said, it now appears that brands and suppliers have dramatically slowed and adjusted orders and inbound shipments, or have canceled them, and are focusing on reducing the inventory they've built up since the last quarter of 2021 and into the first quarter of 2022. The bottom line is that too many retailers are sitting on too much inventory. Now, following that theme through to the bigger retail world, this chart shows the inventory situation faced by major American retailers, including the largest retailer of bicycles, going into the 5-day Thanksgiving, Black Friday to Cyber Monday holiday. Amazon, way out of whack. Target, out of whack. Walmart, way out of whack compared to what it was, but still doing better than Target is. And the winner here is Best Buy. And you can go through other charts, but the bottom line is that all major, not all, the majority of major retailers are in the same boat as Amazon, Target, and Walmart. What this amounts to is this chart. And this gives you a good idea of what the inventory overhang looks like. And this also is about what the situation is for the American bicycle business. So time-wise, 2020, 2022. General merchandise stores inventory to sales ratio. And you see it in 2020 fluctuating as product was disrupted, was not available. You see it coming down, then slowly building and building as we get into 2022, up to a point where you're looking at inventories of 5.5 to 6, which could equate to 6 times retail sales. We're told in the bike business that inventory ratio is on average 7 times. Now, this is the same graphic we looked at earlier, except what's added here are the inventory points. The inventory overhang points that we're aware of. Component inventory, I said, is building. I've all related in writing the story of a friend of mine who visited Taichung Bike Week and then went out and called on plants in Taiwan and found inventory in buildings that didn't exist before, these warehouses that were built full of inventory waiting for orders to come in. So there's a component inventory overhang in Asia at this point. The finished goods have slowed down, and probably this finished goods inventory is receded to the point where it's normal flow. But where it's ended up is it's pushed into the inventory build at fulfillment centers, distribution warehouses, company warehouses, and also at retailers. So a big inventory in componentry here, a big inventory in finished goods inventory in the United States here in the wholesale and retail sides, as demand from consumers has receded. The inventory warehouse squeeze has created some interesting phenomenon relative to the problems of where do you put it all. Now, we state that warehousing, we think, has peaked in the sense that U.S. bicycle brand finished goods and aftermarket warehouses appear to be full to overflowing. So therefore, you got companies like Amazon that are backing away from leases and actually shutting down projects to expand warehouse space. At the same time, as this article indicates, what has been gobbled up in the way of warehouse space by the big guys is making it very difficult for smaller companies to get any warehouse space at all. And what they're doing is storing goods in containers and trailers in parking lots. So now the smart real estate companies that have been leasing and selling warehouse space are leasing and selling parking lot space. And that all sounds very interesting, but it means that inventory is building and being stuffed in every nook and cranny that it can be stuffed into. And that includes what's occurring in the bicycle business. Inflation is driving global markets and economies. The consumer demand that creates that is the key. It is what this is all about. The Institute of International Finance calculates that inflation is now driven by the energy stock from the Ukraine war, the energy shock, not stock, the energy shock from the Ukraine war rather than the cost of supply disruption. So what's shifted here is the impact of inflation, the impact of the financial and economic disruptions has shifted from what's been driven in the past by supply chain disruption, which to great measure was caused by COVID-19 problems, to the energy shock from the Ukraine war. Now, the bicycle business stands out as an early indicator of reduced consumer demand beginning the last quarter of 2021, at a time when consumer purchasing was shifting from goods and services, but remained robust in the face of the highest inflation in decades. It's about demand. It's about demand and buying behavior. First, consumers don't need the same hard goods. They're back doing travel. They're back to buying services. The second is so much uncertainty in the economy. And of course, there's inflation. The third is that companies are sitting on inventory, so there isn't the same throughput. What this amounts to is bicycle brands and their dealers paid the highest prices they've ever paid for finished goods and the highest cost of shipping that they have ever paid, while those goods remain in warehouses unsold because consumer demand has receded to the lowest level. Since we're told, by the way, by the industry, the lowest level since 2015. So what's a shakeup? Some of you have not experienced one. I mentioned a shakeout several times in this presentation from 1975 that lasted about 5 years. Shakeout is a term used in business and economics to describe the consolidation of an industry or sector in which businesses are eliminated or acquired through competitive pressure. Human Powered Solutions is of the opinion that the American bicycle business has entered a shakeout that could last from 3 to 5 years. This coincides with the end of the golden age of globalization and the new era of realignment and reconfiguring bicycle business supply chains to supply networks of supply ecosystems. Now, this is as Alan Beadle, author of the Trade Secrets newsletter, has opined. Again, we're not saying that there will no longer be globalization. We're saying that this calm golden age has ended, agreeing with the Commerce Secretary from Singapore, and also saying that it's changing and morphing so that we're seeing variations of supply chains and supply networks that are different than what we experienced in the past. Part of what's going to do that, make that change occur, is the shakeout. Shakeouts also can occur after an industry has experienced a period of rapid growth in demand, followed by over expansion by brands and retailers. Sound familiar? In short, a shakeout is a business situation in which people lose their jobs and companies go out of business because of economic difficulties. The pieces on the right, by the way, were taken directly from Walmart on Black Friday, just off of an advert from Walmart online soliciting and asking for people to come buy from them with up to 65% off. And Walmart is the mass retail merchant considered to be in best shape of all of the retail merchants in the category. They're also the largest seller of bicycles. Now, in conclusion, I want to point out that e-bikes have changed the game. What the current NBDA consumer research does clearly show is e-bikes have changed and expanded bicycle design and style. One-step distribution, focusing on direct-to-consumer, the D2C, and the sophistication and technical complexity, including risk management of electric propulsion systems. Bicycles, we'd pretty well gotten comfortable with the sophistication and the technology of bicycles. Electric bikes have changed that. Now, I'm not going to spend a lot of time on this, but about 30% of consumers who purchased and rode bicycles, which includes e-bikes during the 2020-2021 period, according to the NBDA consumer research, were new to cycling. And about 20%, an additional 20%, returned to cycling, hadn't ridden for years and returned to cycling, meaning about 50% were ongoing or continuing cyclists. So e-bikes attracted new and returning cyclists who care less about proper fit and more about convenience, utility, and fun. They don't see or care about men's or ladies' bikes. They care about step-through. They care about ease of riding. They care about all of the stuff that makes cycling fun, rather than what we looked at as the technical expertise that went into being a cyclist. There are electric assist models in traditional bicycle brands' lines of products, and there are new 20-inch and 24-inch fat tire models with design, looks, and features taken from motorcycle and moped designs. And this has been recognized in the market, but these may be, in fact, the NBDA says in their consumer research, they are new cyclists, new people coming into cycling and riding bicycles for the first time. There are on-road and off-road e-bikes that go well beyond the conventional gravel and off-road bikes, and they appeal to a wider range of users and potential users. Keep in mind that this is, to us, a sea shift in the bike business and in the consumer perception of bicycles and of the buyers. Many of the non-conventional or new wave e-bike brands are direct to consumer or D2C. Others are a combination of D2C and mobile delivery, while others are D2C and brick and mortar combinations. The traditional bicycle business still has not completely recognized or accepted that the mainstream traditional bicycle business has been changed by the pandemic, and e-bikes have come into the market and have changed from the traditional bike business to micromobility, so that we now are in a micromobility business with a wider human transportation and mobility scope that also has greater potential for growth going forward if we learn to accept it and manage it properly. One of the major challenges facing the traditional mainstream bicycle business and the new wave e-bike business is safety and safety regulation of propulsion systems, and specifically lithium-ion batteries that are common to all e-bike propulsion systems. This is a topic for another time, but one that has already played into the new era of supply networks and ecosystems. And it will be a topic for presentation and discussion at the upcoming CABDA expos and future NBDA webinars. Now, it's no surprise that companies and brands that have sourced their global supply chains in China for decades, and more recently are selling their products to the emerging Chinese consumers, are having difficulty to move away from China as the geopolitical situation makes it harder to continue to stay in the PRC. The bicycle business isn't high tech, but from the US standpoint has been dependent on the combination of Taiwanese and Chinese manufacturing, engineering, and expertise for 3 decades. American bicycle and e-bike brands can design and engineer products, but they rely on the original equipment manufacturers or OEMs for manufacturing engineering and expertise. Leaving China means figuring out how to maintain the level of quality manufacturing that is available from Chinese OEM sourcing. And I might add that that level of manufacturing expertise has accelerated with e-bikes. Part of the equation is that the majority of Chinese export OEMs to the US and to the US market are owned or controlled by Taiwanese companies. Also, some of the American brands have become multinationals that sell their products to Chinese consumers. Now, this is a Brain headline from November 23rd. It demonstrates that the new era of supply networks is not only here, but gives an idea of what it looks like and how it's beginning to develop and evolve. Just as the golden age of globalization is ending in that pleasant place that changes with the seasons, but with very little or any real disruption beyond that, fades away with the McDonald's theory. The American bicycle business is entering a new era of supply networks or supply ecosystems, propelled forward by e-bikes and the new bicycling consumer that they brought into the marketplace. So in summary, very quickly, we've looked at what the golden age was. We've looked at the pandemic and what it accelerated relative to change in the bike business. We looked at the McDonald's theory. We looked at some of the things that can be fixed and some that are changed forever. We've discussed why inventory is evil. We've looked at consumer demand, why it's all about consumer demand. We've talked about a shakeout and what that is. We've talked about e-bikes and how they've changed the game. The new era of supply networks, and this will be a topic that we'll expand on at the CABDA expos. And so, Rochelle, it's time for question and answer, and I hope we have a few minutes for some of those.
Yes, we do. All right. The first question is, will the Chinese tariffs come back?
That's a very interesting and long question. The Chinese tariffs are on the verge of coming back. Right now, the USTR, the United States Special Trade Rep, is conducting a study, is going to publish a paper that will tell us whether they're going to bring them back or not, effective the end of this year. But I would suggest that you watch carefully what the USTR is deliberating on. Stay close to People for Bikes and what they're lobbying and what their feedback is from Washington, D.C. Unfortunately, the chances of those tariffs coming back are still in play. I would give it a 5-0-5-0 right now. It's not good, it's not bad, but it certainly is not swinging in our favor.
Thank you. Next question is, do you expect that the just-in-case inventory strategy was transitory while it contributed to the current industry challenges? Do you expect that most suppliers and retailers have already started the shift back to just-in-time?
I think that most have shifted back to just in time out of necessity, financial necessity. I do not think it was transitory because it actually, if you look at the history of it, it's what the Taiwanese based, once they got the legs under them by the early 80s, it was the fundamental base of Taiwanese manufacturing methodology that they transferred to China. You might recall the A-Team, where the Taiwanese industry included American groups and companies, and every year delegations to Japan to study for 2 weeks with Toyota and studied the just-in-time system. So I don't believe it was transitory, and I think what you're going to see is led by the Taiwanese industry, the bicycle business, both in the United States and both in Asia and Europe, and then by caveat, the United States, is going to find, like it will with globalization, a new version of JIT that will be compatible with the new global networks, supply networks in the supply chain. So I think we're going to go back to JIT. Moving away from it was problematical in that there was nothing basically to fill the void for a period of time. If you stayed with JIT, you couldn't operate it because of the disruption. But going back to JIT will be tied, I think, very much to the new supply chains and the new supply networks, and it'll be a different version of JIT.
I've missed some of your presentations on the bullwhip effect. The first whip resulting from overzealous ordering is clearly apparent, but do you expect that there will be an overcorrection that will lead to shortages in certain categories over the next 12 months?
Highly probable. By the way, the NBDA has all of the presentations available. So you can contact Rochelle or look on the NBDA website. And I think there's 2 or 3 presentations that touch on or cover the bullwhip effect in large measure. Or you can contact me. I'm more than happy to provide what I can. But yeah, you raise a good point, and I think it's highly probable that it's like Newton's laws. I guess it's the third law that says for every action there's an equal and opposite reaction. That there will be an overcorrection in some cases by some companies. This is not easy. This is the disruptions and the uncertainties that we're experiencing right now are unprecedented. Like everything that's happened since March of 2020 to this industry, unprecedented changes, things that have never happened before. And so we're going to have to work our way through. And yes, what is possible is an overcorrection of the opposite of the bullwhip effect on the other side as we come out of this.
Will the shakeout lead to increased dumping? Like one of our manufacturers we represent is offering direct-to-consumer free shipping at our original wholesale.
Sadly, I don't like the term dumping because for years I was testifying both to the USTR, to Congress, and to the folks in Washington about dumping. But that being said, yeah, you're correct. It's already started. One of my partners related a story of one of the largest retailers, bicycle shop retailers in the country, having an overstock of the leading brand of componentry, having to do something with it, got on the internet, found buyers among the other bike shops. One of those buyers came in, bought up all of his excess inventory at 10 cents on the dollar. He made his cost plus 10%, and paid cash. Went up room and counted it out cash. It was a lot of money. That's loss of control. The distribution that distributor, that brand had, that the distributors for that brand had at that point were gone. And the dealer was doing what he had to do. He was improving his cash flow. The purchasing dealer was getting what he wanted. He had cash that he could invest and make high margin on over time, because now he could afford to stretch that inventory he bought at 10% above cost over a period of time and make a good margin on it. But that's all, losing control. And I think you're going to see more of that. It is dumping. And on a bigger scale, are we going to see that internationally? Yes, I'm afraid so. Europe will be able to insulate itself more than the United States, because they've been active with their anti-dumping and anti-dumping laws. The United States has watered those down. Speaking from personal experience, I know we've watered them down, and it's going to be much more difficult. The whole concept of globalization, of freely moving goods across borders with little or no interference, is going to be disrupted. But part of that disruption will be the literal dumping of componentry, bicycles, e-bikes, of products into the markets.
Thank you. Next question. IKEA is in the headlines for signaling that they will lower prices as their cost of production has dropped. Do you expect bike mat prices to start dropping? Clarification, I'm not talking about discounted MSRPs to resolve inventory balances.
It's going to be difficult. This is the same issue that the container shipping business faces. Those sailings being blanked, the sailings being cut, is part of what we're being warned will be a container price war. The container companies have made huge profits across the board. I'm not saying that the bike industry made huge profits, but economically, everybody in the chain of distribution in the bike business made good to excessive profits or margins. And in turn, they're going to be reluctant to give them up. So the weakest or the most financially crippled and the financially needy will start to cut pricing and dump. Again, I don't like that term, but it's being used in this conversation, I think, accurately. They're going to put pressure on the other brands and manufacturers that want to hold pricing to maintain margins. And this all depends on, if I'm wrong and this doesn't last, the shakeout doesn't last 3 to 5 years, then there's going to be the ability to maintain some of the pricing. If I am right and it does last 3 to 5 years, then I do think you're going to have to be very careful as an OEM on pricing, or if you're in the chain of distribution with OEMs, you're going to have to look very carefully at pricing policies.
What is the future of reshoring in the USA? When will Shimano build its first manufacturing plant here?
Good question. A long answer. I'll try to make it short. The cluster of component manufacturers in the US is absolutely essential to manufacturing in the US. Now, that cluster of component plants can be nearshored in Mexico, in Canada, probably even in South America, but it's got to be close. You've got to have the component supply in order close to the manufacturing base and the consumers in order to make it all work. We don't have that. Europe does, we don't. So the reason that Giant and Shimano back in first quarter, second quarter 2020 said, hey, there's a boom coming. I think they misread that. It was a surge, or they misstated it. They didn't misread it. Many people misread it as a boom. But there's certainly an uptick in sales coming. We are not going to build plants. We're going to expand capacity within the existing walls that we own, because they realized that if they started then with site selection, all of the processes to get a plant up, it wouldn't be built today. They wouldn't have that capacity today. They'd be in the process of finishing it. So, and by the way, in a downturn. So it was for public companies a sound decision. They're not greenfields. They're not Tesla. It's not that kind of industry. It's not that kind of business. For them to now make the decision, Shimano, Giant, to come into the US, to build a plant, to retrofit a plant, is going to be very dependent on whether they can get the component people to come with them or be available to them. So I would like to think it would happen tomorrow. You can talk to Arnold Kamler, chairman of the board at Kent International, or his son Scott, who can give you more detail, because they are the largest assemblers in the United States, with a plant in, as you're aware, in South Carolina. But they are not manufacturers, and they understand the limitations by not having that component cluster available to them. It's going to be either a major commitment on the part of a Shimano and its stockholders, or it's going to be them leading the charge with a group of component manufacturers coming with them. My guess would be in Mexico or in adjacent countries, so that it would be a nearshoring combination, or what we're referring to as the globalization networking going forward. But there's much, much more to this question. Would be happy to get into detail offline.
Thank you. This looks like the last question. So it is, how does demographics play in the bike space? It seems to me the older generation are moving to e-bikes.
Huge, absolutely huge. And that was the conventional wisdom. I think what the NBDA research showed this year, and it needs to be my advocacy is needs to be done again next year, so this coming year. So I hope that there are sponsors out there to work with the NBDA to keep this consumer research going. Demographics will be huge, but I think that what the e-bike business showed, the e-bike sector and the growth of e-bikes showed, is there are two groups of consumers that we didn't pay any attention to, thinking that it was going to be old people like me that would buy e-bikes. And that is millennials born from 1981 through 1996, ages 26 to 41, and Gen Z, born 1997 to the present. If you want to go up to 2004, those are Americans 18 to 25 years of age. Those two cohorts, and in particular Gen Z, are looked at as the drivers of the future economy. I think they're the drivers of the e-bike business, and I do think that they will be the drivers of the bicycle business, and therefore the bicycle business being able, or the micromobility business that we're morphing into, being able to understand that shift in demographics and taking advantage of it, and focusing on these younger consumers who, by the way, can't afford what the older consumers could. So you have to figure out different ways to provide product and help them pay for it. But with that said, I think that will be the more important cohorts within a major shift in demographics. So demographics will be extremely important to the industry going forward.
Thank you, Jay. As you alluded to earlier, if anyone watching the recording has a question, or if you think of a question later, please feel free to email it. Jay's email is on the screen right now, or you can send it to info@nbda.com and we will get it answered for you. Thank you so much for your time today, Jay.
Oh, you're more than welcome. I hope that it's been worthwhile to the audience. And if anybody wants to contact me, don't hesitate to call my mobile number if you don't want to email.
Thanks so much.